Using ratio analysis. A input-output ratio, inventory control can also be exercised by the use of input-output ratio analysis. Input-output ratio is the ratio of the quantity of input of material to production and the standard material content of the actual output. This type of ratio analysis enables comparison of actual consumption and standard consumption, thus indicating whether the usage of material is favorable or adverse. B. Inventory turnover ratio, computation of inventory turnover ratios for different items of material and comparison of the turnover rates provides a useful guidance for measuring inventory performance. High inventory turnover ratio indicates that the material in the question is a fast-moving one. A low turnover ratio indicates overinvestment and locking up of the working capital in inventories. Inventory turnover ratio may be calculated by using the following formulae. Inventory turnover ratio equals cost of materials consumed during the period / cost of average stock held during the period. Average stock equals 1/2, opening stock plus closing stock. Average No of days of inventory holding equals 360 days or 12 months divided by inventory turnover ratio. Physical control. A 2-bin system. Under this system each bin is divided into 2 parts. 1. Smaller part, should stock the quantity equal to the minimum stock or even the reordering level, and the other to keep the remaining quantity. Issues are made out of the larger part, but as soon as it becomes necessary to use quantity out of the smaller part of the bin, fresh order is placed. 2-bin system is supplemental to the record of respective quantities on the bin card and the store's ledger card. B. Establishment of system of budgets. To control investment in the inventories, it is necessary to know in advance about the inventory's requirement during a specific period, usually a year. The exact quantity of various types of inventories and the time when they would be required can be known by studying carefully production plans and production schedules. Based on this, inventory's requirement budget can be prepared. Such a budget will discourage the unnecessary investment in inventories. See perpetual inventory records and continuous stock verification. Perpetual inventory represents a system of records maintained by the stores department. It in fact comprises I. bin cards, and 2. stores ledger. The success of perpetual inventory depends upon the following. A. The store's ledger dash, showing quantities and amount of each item. B. Stock control cards, or bin cards. C. Reconciling the quantity balances shown by A. and B. above. D. Checking the physical balances of a number of items every day systematically and by rotation. E. Explaining promptly the causes of discrepancies, if any, between physical balances and book figures. F. Making corrective entries where called for after step E. and G. Removing the causes of the discrepancies referred to in step E. D. Continuous stock verification. The checking of physical inventory is an essential feature of every sound system of material control. The system of continuous stock taking consists of physical verification of items of inventory. The stock verification may be done by internal audit department but are independent of the store and production staff. Stock verification are done at appropriate interval of time without prior notice. The element of surprise, that is essential for effective control of the system. Advantages of perpetual inventory. The main advantages of perpetual inventory are as follows. 1. Physical stocks can be counted and book balances adjusted as and when desired without waiting for the entire stock taking to be done. 2. Quick compilation of profit and loss account, for interim period, due to prompt availability of stock figures. 3. Discrepancies are easily located and thus corrective action can be promptly taken to avoid their recurrence. 4. A systematic review of the perpetual inventory reveals the existence of surplus, dormant, obsolete and slow-moving materials, so that remedial measures may be taken in time. 5. Fixation of the various stock levels and checking of actual balances in hand with these levels assist the storekeeper in maintaining stocks within limits and in initiating purchase requisitions for correct quantity at the proper time. Advantages of continuous stock taking. The advantages of continuous stock taking are: 1. Closure of normal functioning is not necessary. 2. Stock discrepancies are likely to be brought to the notice and corrected much earlier than under the annual stock taking system. 3. The system generally has a sobering influence on the store's staff because of the element of surprise present therein. 4. The movement of store's items can be watched more closely by the store's auditor so that chances of obsolescence buying are reduced. 5. Final accounts can be ready quickly. Interim accounts are possible quite conveniently. Disadvantages: annual stock taking, however, has certain inherent shortcomings which tend to detract from the usefulness of such physical verification. For instance, since all the items have to be covered in a given number of days, either the production department has to be shut down during those days to enable thorough checking of stock, or else the verification must be of limited character. Material issue procedure. Issue of material must not be made except under properly authorized requisition slip. Usually it is the foreman of a department who has the authority to draw materials from the store. Issue of material must be made on the basis of first in first out, that is, out of the earliest lot on hand. If care is not exercised in this regard, quality of earliest lot of material may deteriorate for having been kept for a long period. One issue against material requisition note: it is the voucher of the authority as regards issue of materials for use in the factory or in any of its departments. After receipt of material requisition slip, storekeeper ensures that requisition is properly authorized and requisitioned quantity is within the quantity specified in bill of materials. After satisfied with the documents, storekeeper issue materials and keep one copy of based materials and record the transaction in the records maintained by the stores department. 2. Transfer of material. The surplus material arising on a job or other units of production may sometime be unsuitable for transfer to store because of its bulk, heavy weight, brittleness, or some such reason. It may, however, be possible to find some alternative use for such materials by transferring it to some other job instead of returning it to the store. 3. Return of material. Sometimes, it is not possible beforehand to make any precise estimate of the material requirements or units of production. Besides, at times due to some technical or other difficulty, it is not practicable to measure exactly the quantity of material required by a department. In either case, material may have to be issued from stores in bulk, often in excess of the actual quantity required. Where such a condition exists, it is of the utmost importance from the point of view of materials control that any surplus material left over on the completion of a job should be promptly handed over to the storekeeper for safe and proper custody. Unless this is done, the surplus material may be misappropriated or misapplied to some purpose, other than that for which it was intended. The material cost of the job against which the excess material was originally drawn in that case, would be overstated unless the job is given credit for the surplus arising thereon. The surplus material, when it is returned to the storeroom, should be accompanied by a document known either as a shop credit note or alternatively as a store's debit note. Valuation of material issues. Materials issued from stores should be priced at the value at which they are carried in stock. But there can be a situation where the material may have been purchased at different times and at different prices with varying discounts, taxes, etc. Because of this, the problem arises as to how the material issues to production are to be valued. There are several methods for tackling this situation. The cost accountant should select the proper method based on following factors. 1. The frequency of purchases, price fluctuations, and its range. 2. The frequency of issue of materials, relative quantity, etc. 3. Nature of cost accounting system. 4. The nature of business and type of production process. 5. Management policy relating to valuation of closing stock. The following are the major methods of valuation of material issue. 1. Cost price method. 2. Average price method. 3. Market price method. 4. Notional price method. Let us discuss in details each of these methods in details. Cost price method. The following are the commonly used methods under cost price method. 1. Specific price method. This method is useful, especially when materials are purchased for a specific job or work order, and as such these materials are issued subsequently to that specific job or work order at the price at which they were purchased. To use this method, it is necessary to store each lot of material separately and maintain its separate account. 2. First in first out, FIFO, method. It is a method of pricing the issues of materials, in the order in which they are purchased. In other words, the materials are issued in the order in which they arrive in the store, or the items longest in stock are issued first. Thus each issue of material only recovers the purchase price, which does not reflect the current market price. This method is considered suitable in times of falling price because the material cost charged to production will be high while the replacement cost of materials will be low. But, in the case of rising prices, if this method is adopted, the charge to production will be low as compared to the replacement cost of materials. Consequently, it would be difficult to purchase the same volume of material, as in the current period, in future without having additional capital resources. 3. Last in first out, LIFO, method. It is a method of pricing the issues of materials. This method is based on the assumption that the items of the last batch, lot, purchased are the first to be issued. Therefore, under this method the prices of the last batch, lot, are used for pricing the issues, until it is exhausted, and so on. If however, the quantity of issue is more than the quantity of the latest lot than earlier, lot, and its price will also be taken into consideration. During inflationary period or period of rising prices, the use of LIFO would help to ensure that the cost of production determined on the above basis is approximately the current one. This method is also useful especially when there is a feeling that due to the use of FIFO or average methods, the profits shown and tax paid are too high. 4. Base stock method. Minimum quantity of stock under this method is always held at a fixed price as reserve in the stock, to meet a state of emergency, if it arises. This minimum stock is known as base stock and is valued at a price at which the first lot of materials is received and remains unaffected by subsequent price fluctuations. This method of valuing inventory is different from other methods of valuing issues, as the base stock of materials are valued at the original cost, whereas materials other than the base are valued using other methods like FIFO, LIFO, etc. This method is not an independent method as it uses FIFO or LIFO. Advantages and disadvantages of this method depend upon the use of the other method, viz., FIFO or LIFO. Advantages and disadvantages of specific price method. Advantages. The cost of materials issued for production purposes to specific jobs represent actual and correct costs. This method is best suited for non-standard and specific products. Disadvantages. This method is difficult to operate, especially when purchases and issues are numerous. Advantages and disadvantages of FIFO. Advantages. It is simple to understand and easy to operate. Material cost charged to production represents actual cost with which the cost of production should have been charged. In the case of falling prices, the use of this method gives better results. Closing stock of material will be represented very closely at current market price. Disadvantages. If the prices fluctuate frequently, this method may lead to clerical error. Since each issue of material to production is related to a specific purchase price, the costs charged to the same job are likely to show a variation from period to period. In the case of rising prices, the real profits of the concern being low, may not be adequate to meet the materials purchase demand at the current market price. Advantages and disadvantages of LIFO. Advantages. The cost of materials issued will be either nearer to and or will reflect the current market price. Thus, the cost of goods produced will be related to the trend of the market price of materials. Such a trend in price of materials enables the matching of cost of production with current sales revenues. The use of the method during the period of rising prices does not reflect undue high profit in the income statement as it was under the first in first out or average method. In fact, the profit shown here is relatively lower because the cost of production takes into account the rising trend of material prices. In the case of falling prices, profit tends to rise due to lower material cost, yet the finished products appear to be more competitive and are at market price. Over a period, the use of LIFO helps to iron out the fluctuations in profits. In the period of inflation, LIFO will tend to show the correct profit and thus avoid paying undue taxes to some extent. Disadvantages: calculation under LIFO system becomes complicated and cumbersome when frequent purchases are made at highly fluctuating rates. Costs of different similar batches of production carried on at the same time may differ a great deal. In time of falling prices, there will be need for writing off stock value considerably to stick to the principle of stock valuation, i.e., the cost or the market price, whichever is lower. This method of valuation of material is not acceptable to the income tax authorities.